the case for Brexit, for you, is more about an ideological principle rather than an economic cost-benefit analysis.
It's both. I mean, if you look at the formation of the economic crisis in Europe, it's broadly been brought about because the euro was introduced as a political experiment rather than an economic experiment. Germany has a currency rate that is 35% too cheap for its economy. The South and the East have got a roughly 35% too expensive, and the thing is ripping itself to pieces.
I would agree with you on that, Mr. Banks. And so, keeping us out of the euro was one of the best decisions of the last Labour government. But we're not in the euro. This referendum is not on the euro. It's on our membership of the EU.
If I can finish what I was going to say. So you have an economic situation that can only be resolved one way, and that must be by total integration of the remaining countries. And it must be with a massive transfer of surplus from north to south and east. That's the only way it can be resolved. So this concept that we can kind of sit on the edge of it and avoid the worst of it is wrong. When the crisis comes, it will invariably suck us in. We paid for the Irish crisis, we paid for the Greek crisis, we will invariably be drawn into this. So my supposition is that economically it's a disaster. And I would pay almost any price to be on the, away from it.
Well, I mean, one could argue that even if we weren't in the EU, we would be affected by a crisis on our doorstep. Yes. But also it is the case that the Prime Minister has got us an opt-out of paying for crises relating to the euro, the single currency. I'll just go back to my point there, because my question really was, even if there is an economic cost, for you, Mr. Banks, it is the ideological principle, which, again, is totally valid. But I'm just trying to, where you're coming from on this. That is more important than the cost-benefit analysis.
I mean, the basic bottom line is, even if you took the worst-case scenario, which is where World Trade Organisations and pay the tariff, that's 2/3 of our membership fee. The fact of the matter is that this assessment is based on a load of falsehoods. It assumes that there's full single market in financial services. The EU trade deal we do is no better than Canada, and there's no productivity gains from any of the regulations. Well, I mean, if you had to put together a work of fiction, the Treasury report is that.
Well, then let's look beyond the Treasury report. The IMF, the World Bank, the OECD, the London School of Economics, Oxford Economics, all of the economists and the major investment banks have all given opinions indicating that Brexit could be economically damaging. Why would all of them be making the same argument, Mr.
As a bank that had no mortgage debt on its books in 2008, every single one of those institutions missed what was spectacularly the biggest financial bubble the world has ever seen. I think they're just wrong. I mean, the Treasury recommended the RM, the PEG, that they destroy more British industry than the Luftwaffe.
The Treasury also recommended that we don't go into the euro, something that you would have agreed with, Mr. Banks.
In 2003, the Treasury suggested that if we join the euro, it would increase our exports trade by 50%. The Treasury's track record is not good, nor is the IMF. The IMF suggested we should join the euro. The IMF also criticised George Osborne and his austerity package, saying that it would lead to massive unemployment 4 years ago. They have a woeful track record. They are led by a massively Europhile person. And, thank heavens George Osborne didn't listen to them 4 or 5 years ago. But you can't pick and choose. The reality is, you talk about economists, probably 4 of our best city economists, so Roger Bootle, Ruth Lee, Tim Congdon, and the Mayor of London's economist Gerard Lyons, all have written papers and recommend Brexit. And they are, I think, some of the most highly respected economists in the City of London.
Well, let's look at the most respected economists and institutions. The Bank of England governor has said that Brexit, he said this at our committee, was the biggest domestic risk to financial stability. Vote Leave thought that this was scaremongering. Do you think that the Bank of England governor is scaremongering?
I was on Newsnight that night after he spoke, and I made it very clear he was referring to a domestic risk. He also referred in the same hearing to the global risks, which were much bigger, of what's going on in China, what's going on with the commodities crisis, and by implication, what's going on in America. Businesses have uncertainty and risks every day of the working week. This is just another uncertainty that will be there for a period until we negotiate a new trade agreement. But he made it very clear, it's a domestic risk.
Yes, it's a domestic risk. It's
but
the
he also
biggest.
said,
sorry, Mr. Tice.
Well,
he said it was the biggest.
You shouldn't have general elections, because a general election, people start getting worried about what's going to happen in the general election. There's always risk. There's always uncertainty. This political or politicians' ideas that you live in this kind of risk-free world that doesn't have risk attaining to it. We control nothing.
Yes, and that's general elections, Mr. Banks. It's up to the electorate to decide, and at this referendum, it's up to the voters to decide whether we stay in the EU or leave the EU. But when they're making that decision, they need to know what the risks are. And the Bank of England governor said not that the referendum was the biggest domestic risk, but that Brexit was the biggest domestic risk to our financial stability. It's not an argument against referenda or against elections, but is about telling people what the risks and implications of their decisions are.
But in general terms, establishment, politicians, civil service don't like change. So by definition, any change is a risk and is uncertainty.
But I do think it's important to have the overall context, which is in the same hearing he referred to the global risks. I don't think it's right to just cherry-pick and infer that that's all he was alluding to.
I wasn't, Mr. Tice, cherry-picking. I recognise that there are many risks to financial stability, both global and domestic. But I would argue that at a time when our economic recovery is still fragile, and you would have seen the GDP numbers today showing that GDP growth has fallen, that construction, investment and agricultural output have all fallen, it would be a dangerous time to take on more risks. And the Bank of England governor, and you've spoken about other economists' views, but I would argue, and I think most people would see the Bank of England's governor as the most respected economist. He thinks it's the biggest domestic risk to financial stability. You don't
by the way,
share
I don't
that
even
view.
believe it's the biggest domestic risk to stability. The Bank of England has printed £500 billion of quantitative easing. It's bought back bonds, its own bonds. It's collapsed interest rates to zero for 8 years and created asset bubbles all over the place, from property to stock market to the like. The biggest domestic risk this country faces is a deflation of those asset bubbles.
What do you think the implications of leaving the EU would be on interest rates, Mr. Banks?
In what sense?
Well, what do you think will happen to interest rates, Mr. Banks?
Interest rates in America are zero. Interest rates in Switzerland are negative. Interest rates in Japan are zero. And interest rates in the UK will remain zero because everything's buggered. And that's why it's all at zero. Well, so you can say that interest rates go up, but
I didn't say.
I'm saying it won't.
Mr. Banks, I didn't say anything about what would happen to interest rates. I was asking Mr. Banks. The way these committees work is we ask questions and you answer them. Well, you haven't listened to the question. My question was, what do you think, Mr. Banks, will happen to interest rates in the event that we leave the European Union?
I was attempting to answer that. The interest rates worldwide are either zero or negative, and they will remain at zero or negative in this country, whether we Brexit, exit or Lexit or do anything else.
So you don't think there'll be any implications?
Absolutely not.
I don't think there'll be any implication at all. Interest rates are not set by whether or not we are a member of a political union, and for people on the Remain camp, such as the Prime Minister, to suggest that mortgage rates would rise is complete and utter nonsense. Interest rates are set by totally different economic factors.
By the way, interest rates should rise. Do you think it's normal to have 0% interest rates? It's telling you something, isn't it, really?
So you think that interest rates should rise? If you were the Bank of England on the Monetary Policy Committee, you'd put up interest rates?
You're putting words into my mouth. What
you just said they should rise, Mr. Banks.
I said, in the normal course of events, it's not normal to have 0% interest rates. It's telling you that something's very wrong, isn't it?
Yes. Interest rates of 0.5%. That's the.
They've got negative interest rates in Switzerland and Japan.
I'm not asking about interest rates in those countries. What do you think will happen to sterling Mr. Banks, on the event of
sterling's-
us leaving the
yeah.
European Union?
Sterling's a very good question, because you talk about sort of tariffs on world trade and stuff like that. The actual, in the last 3 months, the pound-euro rate has dropped 10%. That's worth double the tariffs into World Trade Organisation rules into Europe. So effectively, a fall in sterling is not a bad thing at all. We're running a massive trade deficit. We're running a current account balance deficit. In fact, our currency deserves to be a hell of a lot lower than where it currently stands.
So do you think then, Mr. Banks, if we leave the EU, sterling will fall?
I don't think it matters whether it's not Brexit related. Sterling goes up or down, and currencies go up or down, depending on how the markets feel about the underlying factors of the economy. It's nothing to do with Brexit whatsoever.
But it would have an impact, wouldn't it? Because because the value of a currency depends on people's investors' propensity to invest in gilts, in equities, etc. In the country. So I'm just asking, what do you think will happen to sterling in the event of Brexit?
If you want my opinion, I would say it would drop, that it would recover. That's the way of markets. I mean, the last 3 months, the pound has dropped nearly 10% against the euro. In the last week or so, it's recovered 3 or 4% up.
Mm-hmm. So you think then, this is very interesting, it's an important issue as well. So you think the immediate impact of us leaving the European Union would be sterling falling against, presumably, the euro and against the dollar?
Well, look, in a world where economic orthodoxy has been suspended for the duration until it all hits us in the face, which is unfortunately where we've been for the last 40 years or last 20 years, at lower currency rate, everyone in the world is trying to reduce their currency rate, and they're doing it by quantitative easing. So the Japanese are printing money to try and reduce the value of the yen. The dollars, they're printing money to reduce the value of the dollar. The Bank of England's printing money to reduce the value of the pound. They're all trying to reduce their currency rate to become more competitive. So in the event that it did drop 10%, it would matter not, and in fact it would probably boost our export position.
Well, two things. First of all, the main reason for quantitative easing and low interest rates is to try and stimulate domestic demand through both investment and consumption. But the implications of sterling falling would be that the price of imports would go up.
Yep.
And of course we are a net importer, so that would have a positive effect on inflation. So you would expect, at least in the short run, for the costs of goods and services to go up in the event of us leaving the European Union.
Everyone worldwide is trying to fight deflation at the moment. Is the enemy rather.
So you agree that at least the short-run impact would be higher prices?
No.
Sorry, Mr. Tice, I was asking Mr. Banks.
I don't want to dominate it.
No, I'm asking you the question, Mr. Banks.
The point is that you have to have a balance between exports and imports. If you're saying, would prices domestically go up because the pound drops? Yes. Is that a bad thing? No.
Okay, thank you. That's very helpful.
Can I just add to that?
I'm
if you have something you particularly want to add.
Well, I think let's be very clear. If sterling drops due to short-term currency speculators by a few hundred traders in the city for a few weeks, that is not going to have an inflationary impact. The biggest risk that most developed economies around the world have is deflation, not inflation. So I think that's very important. And the reality is currency on a medium and long-term basis, currency rates are set by all sorts of things, and how well an economy is doing and the perception of the ability to repay debt. So it's wrong to just draw the analogy and say Brexit would be hugely damaging for sterling.
Well, I mean, I was having a conversation with Mr. Banks, and most people believe that sterling would fall. Mr. Banks seemed to agree with that, and of course that pushes up the price of imports, which pushes up domestic inflation. That may be a good or a bad thing, but it's just important that we have the facts.
It makes the exports more competitive, and it depends how long it falls for, and whether it falls in the next week as a function of
all
purely
those things are true, but it is important that people understand what the impact of Brexit would be, and I think that's been a useful discussion. Thank you, Chairman.